The first budget of the decade, and a rather short one, was centered around health, hope, and growth. For me, the punchline really has been that the finance minister has come up with a high impactful budget which could be called as a expansionary budget, and the path towards spending is high. It is a budget where the finance minister certainly has given big rollouts to every sector: power, ports, infrastructure. More importantly, there have been no changes in direct taxes. So while there is a change in terms of the basic ideology of taxing the super rich every time the company needs money, this is something which markets are always afraid of. Change in direct taxes, which has not happened, a big hurrah. It's an expansionary budget. It's a budget where government understands the priority, and every sector individually has got a tick mark in terms of prioritization. Maithili, I just want to take your quick reaction. This is an expansionary budget, and boy oh boy, I'm mighty relieved, no change in direct taxes.
Well, yes, it certainly is an expansionary budget. So in fact, for all the criticism of the government that had been very niggardly in giving fiscal stimulus in the past, particularly as compared to other governments, I think these numbers, one will have to go through the fine print, but if one goes by these numbers that the finance minister has presented, 9.5% is a very good, good quote-unquote fiscal deficit number to end the current year. And there's also the promise of bringing it down to 6.5% next year. So I think overall, yes, it is definitely an expansionary budget with a roadmap for reducing the fiscal deficit. Best of all, the government's borrowing has been kept at that 12 lakh crore, which is more or less the same as what it was this year. So there's not any extra pressure on bond markets. At the same time, we've seen the increase in capital expenditure, which is what we really want. We've seen the increase in healthcare expenditure and agriculture expenditure. There are reformist moves like increasing FDI in insurance from 49 to 74, which is a substantial jump up. Social security for gig workers is an increase in outlay for R&D. There's contractual dispute resolution, direct tax, any dispute resolution it's been improved, streamlined. So I think there are a number of measures that the government has taken in order to ensure that it walks the talk. There are, of course, some measures which I'm not entirely happy with, in the sense that a development financial institution, yes, there's been a lot of talk about this before the budget, but we already have tried this in the past. The problem with infrastructure projects really is of execution risk. So unless the government resolves that and gives autonomy to the new development financial institution, I'm not sure really that this will be an answer. The recap of public sector banks is grossly insufficient. They have talked about privatization of some banks, but given the promise last year of...
Maithili, I'm coming back to you. Let me just get a very quick reaction from Vibha on the big picture. And Vibha, the big picture clearly is that this is an expansionary budget. The budget is centered around health, hope, and growth.
Nikunj, it's a well-rounded budget and very, very required against us coming out of a pandemic. To your point that no increase in taxes is really providing a lot of stability, and the message that we are here to support, and also that we are here to support and several also somewhat smaller things. So for example, reopening of only within 3 years, rather very clear indication that harassment is not really the purpose. Yes, they will come after wherein, for example, employers don't remit employee dues in terms of social security, but not otherwise. Similarly, the relaxation for senior citizens. You mentioned healthcare. So a lot of focus, and of awaited 74% FDI.
Shefali, no changes in direct taxes. Can I say that is the big headline for this budget, for the Aam Aadmi, for the super rich, for every taxpayer? Nothing changes?
That's right, Nikunj, and this is quite unbelievable, because there was so much of apprehension of a COVID cess or a new kind of wealth tax. So I think this is a big relief, and I think the finance minister has done it right in terms of not tinkering with the tax rates anymore, and just trying to give more assurance to the investor community that we are serious about giving the stability, reducing the disputes. She announced the faceless income tax appellate tribunal scheme as well. So I think these are all very welcome steps and will certainly ease out the disputes the way we are currently handling them in India. So I think, we couldn't have asked for anything more in terms of the way they have not touched any tax rates, given some reliefs to the startups, could have been a little more. But overall, I think we'll have to wait to see the fine print. Like, for example, on the SCZs, etc., the relief for work from home, which was also expected. Maybe it's there, but it might be in the fine print. So we'll wait to read that.
Okay, while we'll continue to dissect the headline and the fine print, the headline is that there is no increase in direct taxes. It's an expansionary budget. This budget, in a sense, is going to be, there is enough and more provision which has been done for all major sectors. The government is looking at monetizing and some of the important assets. But Mr. Kumar, there are two things which we would like to seek your thoughts on. Getting a development bank back. Now this, in a sense, like Maithili said, has been a failed experiment in the past, and the bank recap number, not a very big number in a COVID year.
Yeah, bank recapitalization, I think there was a need for higher capital allocation, but we also have to realize that there are constraints as far as the budgetary resources of the government are concerned. And that is how, like, instead of the expectation of about 40 to 50,000 crore, the number has come to 20,000 crore. And the banks, some of the banks then will have to depend upon raising the capital through the market, which seems to be a bit difficult, but as the situation improves, maybe they will be able to augment their sources and get the capital from the market. About the DFI, this has been a debate, but I think India, in my view, we need a development financial institution. The only issue is about that, what would be its policy and how the execution will happen. And the need for a DFI was being felt, and particularly if there is a project which requires a significant amount of funding, and say 30, 40,000 crore, then the existing system is unable to achieve the financial closure. And many things can be done, and in the budget, not all details will be there. But I welcome this step, and in the budget, the infrastructure on increasing the capex and focus on infrastructure. I think this is a positive, and for achieving higher growth trajectory, the government has preferred to take the route of investing more money in creating the capex and permanent infrastructure, and this can lead to higher growth.
Right. Before I move across to our other experts as well, I just want to quickly bring up the markets as well, because I think the markets are only relieved that there was no higher taxation on the super rich, which one almost thought that the finance minister is going to get into, but the taxes have been completely left unchanged. There has been no COVID cess. Yes, it's been an expansionary budget. The good points are that, there is a capex spend to boost growth, easing of bank credit offtake, divestment policies providing clarity. Yes, the fiscal deficit is much higher than what the markets were penciling in, and this could actually lead to higher inflation as well. And then, of course, there are the other questions on whether or not the central bank policy stance is going to change eventually to try and combat higher inflation. But that is when it actually kicks in. Delivering on divestment progress, of course, is paramount given the track record. This is going to be a tall order for the government. But let's see, we're hopeful and look at the market reaction. By the way, we're back at 14,000, and believe it or not, we're almost clocking in another 25 points, and we would be up 400 points on the Nifty futures, no less. We're staring at a 2.8% move. It's a strong move across the broader markets as well. Sunil Singhania, expansionary budget, something that the markets like, and the markets are only relieved as I see on my screens. We're almost clocking 14,100 now.
So one is, as we discussed in the morning, I think in the run-up to the budget, anyway, the stance was very precautionary. And, once people realize that there is nothing which is sort of negative from a taxation perspective, as was sort of rumored, I think it basically led to, I would say, a rally which was anyway due. Obviously, it's an expansionary budget. A lot of things have been mentioned where, lakhs and lakhs of crores of rupees have been allocated. I think it's good. Obviously, the debt market has been spoofed a little bit because fiscal deficit would go up. But, if US can live with a 15% fiscal deficit and other countries can print money, don't see any reason why India should not follow it, at least for the next couple of years, because we're coming out of a very challenging kind of an environment. In a low interest rate regime, very sure that we will be able to attract a lot of flows. And over a period of time, even this fiscal deficit would be brought back to sanity. So I think it's great, focusing on a lot of spending, and more importantly, it's planned spending rather than expenditure spending. And I think it could not have been better.
The reason why markets are mighty delighted, and that's, I'm going to get first, make a comment here and then get Nilesha. We are, markets are doing cartwheels, honestly. Now, is it because, like Sunil said, because there was no pre-budget rally, and then this is just an adjustment? I think markets are mightily delighted that there is no change in direct taxes. Remember, in 2018, LTCG came out. Then there was a tax on buyback. Then tax on buyback at the end of the receiver. So at a time when growth is the priority, spending is going to be increasing. Fiscal deficit number is something which, looking at the situation of the world, rightly so, the markets, the finance minister has overlooked. There is no large jump in direct taxes. Nilesha, we've been covering 5 or 6 budgets together, and every time post-budget, I've not seen a smile on your face. For a change, it should be different. No direct tax changes.
Yeah, absolutely, Nikunj. This is essentially, honestly, a perfect budget. This is a 10 on 10 budget. It's a budget which does no harm. It doesn't impose new taxes. It doesn't hike taxes. So in a way, it's a budget which essentially ensures that not only just that the status quo continues, but it ensures that there are no restrictions to growth. Growth is not inhibited. There are no measures in this budget. If at all, there are several path-breaking initiatives. I think the whole initiative on divesting stake in 2 PSU banks, I think this is fantastic. This is probably for the first time that the government will be talking of divesting its stake in 2 PSU banks. Probably I haven't seen this post-1969 when banks were first nationalized. So this, in a way, is a path-breaking budget. So I think the markets cheer for this budget, I think, stands on very solid and very good ground. And I clearly believe that an important event which was there for the market to kind of start its rally again, I think that event has been crossed. If at all, I'd say a hurdle has been crossed. And this provides a fresh kind of stimulus for the markets to kind of move forward.
Bala, the fiscal deficit is just under 7. Why are bond markets not nervous?
Yeah, I think interesting, Nikunj. Clearly, the way I think the people are reading the budget is, one, is growth-oriented budget. Second is allocation of resources have been now kept very aptly towards structures that can provide employment, that can create a gross capital formation could be higher, the capital expenditure has been high. And third is the budget also has laid out very clearly various ways and means of finding finance resources for funding various projects, including creating a monetized for monetization of assets of government entities, a separate SPV. Also, something is a welcome move. And third, of course, is around the liquidity that, of course, currently there in the system, which of course is the domain of Reserve Bank of India. Clearly, the liquidity is so large, and despite the fiscal deficit going up to 6.8%, and also the fact that the creation of development financial institutions also, I think, takes away the pressure from the banking system to finance all such needy borrowers to different systems. And therefore, the resource management which the government of India has done, combined with high allocation towards capital expenditure, leading to higher fiscal deficit, and also the high liquidity there in the system, ideally speaking, should not lead to an increase in bond yields. I think if you look at from the time the announced The bond yields have gone up only by about 10 to 12 basis points, which is not significant on a base of already about 6%. Even if the bond yields goes to by another, say, 10, 15 basis points, will it hurt the economic growth? Absolutely no. And will it get money actually for them to fund the various projects or maybe the various needs of the government to bridge the financing? Definitely, the answer is yes, given the fact that the liquidity is large and the investment opportunities for banks are going to be very, very low, given the fact that banks are still not very aggressive in terms of lending. So therefore, the demand for government securities will be high. And third is the foreign direct investments, which otherwise comes into the bond markets, especially the REIT and InvIT. That makes them would have peak actually in those dividend distribution tax applicable for REIT and InvIT. Also to bring in more money in the segment which needs ongoing requirements of funds to refinance the existing projects. And also they have addressed the NHA and the Power Grid Corporation, who are one of the biggest borrowers in the market. They have also addressed the need for tapping the bond market for rising resources. Also should ease off the pressure on government securities market, which generally there always used to be a fear.
Umang Vohra, how is it that you're going to analyze the budget and how would you rate it? It is indeed growth oriented, it is expansionary in nature. We could get into nitty-gritties of the fiscal deficit picture, but prima facie, what's been your reading?
I think, first of all, if there's one word to describe this budget, this is a get well soon budget, get well soon really fast type of a budget, right? So I actually think that I would give it almost an 8 or a 9 on a 10. 8 or 9 on 10, because I think the options were limited, but I think within those options, they've done a really good job. I love the healthcare expansion story. I think this is exactly what we need in India. You don't need a pandemic to discover how to respond. I think the setting up of the biolabs, the fact that there is 60,000 of healthcare infrastructure in the rural and urban centers, I think this drives penetration really deeper. And it's actually in line with the trend we've seen, where we're beginning to see more consumption in tier 2 to tier 6 cities. And actually the metros and tier 1s are actually slowing down compared to what we're seeing in tier 2 to 6. So from my perspective, I think this is a great budget, solid allocations to healthcare. We're very happy.
Shefali, I don't know if you've had the chance to go through the taxation fine print. Is there something that we're missing, or is there actually nothing on personal income taxes?
Well, I think we are yet to see the fine print, but there will always be some things, which is why, I'm a little more conservative, as Umang said. I think I would rather say that it should be 8 out of 10, because no matter what you do, I think while they've tried to do the best in terms of promoting growth and, not tinkering with the tax rates, there will be some aspects which we will find in the fine print. I think largely the announcements that went missing in terms of, what are they planning to do for the special economic zones or for the angel tax? How are they planning to put more money in the hands of the investors to invest back? I think, that those were missing in the speech. Maybe once we see the fine print, we will know more about it. But at least the intentions all seem to be good this time.
The story for me is banks. ICICI Bank is up 10%, and frankly, I don't remember when that happened last time. State Bank of India is up 7%. I'm going to come to Rajneesh Kumar for the reaction on banks. But before that, I want to go to Umang for a number from the budget, which is on the COVID allocation. Umang, in your understanding, if the government is looking at vaccinating 30 crore Indians by August or by September, the number allocated in the budget, is that enough, or that has to be supplemented by states now?
I think it's enough, because I did a rough back of the envelope math. I think if you take 200 rupees per dose, which is what the government's basically buying prices, and give or take a few here or there, 200 to 250 rupees a dose, we're talking about almost a billion plus doses being covered here. So that's enough for a large section of the population. So I think that's enough. And they've also left some leeway there, saying that if we require more, we'll give more. So I think that's a sizable portion of the population of the country. It's pretty sizable and very commendable for them to lay out their 35,000 crores.
Really appreciate your time. I know you've squeezed both our interaction today in middle of 3 meetings. So really appreciate your time and thank you for joining us. Sunil Singhania, what's next? Budget is over.
I think Nikunj, in the morning you started with the fact about earnings and cash flow. I think we'll be back to those two, I would say, factors. And the good thing is that there is continuity as far as the taxation policies are concerned. In fact, there were some very small announcements, but which showed the thought process about the government. A little bit of tinkering with customs duty and all, to ensure that production in India gets a boost. So it was predominantly ensuring that there is a level field, and this whole focus on manufacturing in India really came out. Along with the fact that now with this huge outlay of capital, which the finance minister has laid out, and it's not 1 year, all the announcements were for 3 to 5 years. So I think we have a roadmap of like 3 to 5 years, and that would lead to a big capital formation and a virtual cycle of capex coming back. I think what this country was lacking from 2011-12 to 2020-21 was a capex cycle building up. And now with cement companies and steel companies and metal companies and even on the renewable power side, all of them bracing up for capex, along with this huge push from the government towards infrastructure, metro, and you name it, I think there is a possibility that we go back to the trajectory of 7.5% sustainable GDP growth. And I think if that happens, then this earnings trajectory for corporates, which anyway this quarter onwards, we are seeing a huge upgrade cycle picking up, might surprise on the upside. And therefore, these naysayers who say that, Nifty is trading at an all-time high P and all, might change their views when they realize that on an FY23 basis, suddenly Nifty starts to look at 18.5 times. So as I said, back to earnings.
Okay. Vibha, very basic question, which is, do you think somewhere, looking at the spending and the kind of government push which will come, we should also think about the dreaded word inflation? Nobody in the panel has spoken about it, Vibha.
I think so. And also, let's see how the debt markets, I think you mentioned this earlier also, Nikunj, as to, yes, equity markets are right now on steroids, and perhaps there's a big sigh of relief that is being given, and that's what we're seeing panning out. But let's see how the debt markets also react, and longer term infrastructure bill, the funding requirements for some of the plans, government's borrowing plans, fiscal deficit, and so on. So I think we should temper some of the euphoria, while all the indications much growth centric and get back to normal kind of a message, and is very supportive. We should refrain from the jubilation equity markets seem to be indicating right now.
Mr. Kumar, a quick reaction on the bad bank. We've tried, government has been in a yes and a no mode in order to roll out the entire, emphasis towards bad bank. Looks like bad bank is now a reality. How easy will it be to implement a concept like bad bank? Because, it involves a lot of pricing models and a lot of other elements.
Yeah. Hello, Nikunj. Can you hear me?
Mr. Kumar?
Yeah.
Yes, please.
So about the bad bank, I think as IBA, we were very clear that this is the right time that we need to create a national asset reconstruction company, and I am happy that it has been announced in the budget. And the decision making, in my view, will become faster about the price discovery, how it will be done. These are all matter of details, and even IPA paper, it had all the modalities which it had recommendations around all processes to ensure that everything is done in a very transparent manner. The capability of existing ARC is not sufficient to handle this kind of NPLs which are sitting in the banking system. And the advantage this time is that the banks are made adequate provisions. So that will help. And the capital requirement for the bank as a result will come down. Rest is modality, and this is the first part. And the second part is all about the speeding up of the legal process, including the NCLT. So if the government is able to augment the infrastructure around NCLT, then really we can see some faster resolutions, and the management bandwidth at the bank level, it will be freed up for doing the normal regular banking business, and the focus from stressed asset resolution can move to the new entity which is proposed to be set up.
You know, I just quickly want to mark what the markets are up to, because we're in a frenzy of sorts. 395 points higher for the Nifty, as I see on my screen. And banks are really leading the way. A double-digit move on an IndusInd Bank, on an ICICI Bank, all holding up just so smartly right now. Chola Finance, look at SBI, 6.5% higher. This should make Mr. Rajneesh Kumar happy regardless. Cummins holding up right now. You've got the Bank Nifty, which is really roaring. 5.5% move on the Nifty Bank futures right now. Yes, there are a handful of movers, but I can safely ignore them right now. Bajaj Financial Twins holding out very well. HDFC is moving up 5.5%. You've got an M&M holding out very smartly. Also remember, it's the first of the month, so you've got monthly sales data from M&M, which continues to look very smart. Ultratech Cement, L&T, Shree Cement, Titan, Hindalco, Bajaj Auto, HDFC Bank up 4%, Tata Motors up 3.5%, ITC up 3%. They're all holding out very well. We've also got Ramdeo Agarwal joining in. And before I take it across to Ramdeo, I just want to talk about some of the fine print details that we're getting right now. There is a farm cess of 2.5 rupees per litre on petrol and 4 rupees per litre on diesel. Ramdeo, what the markets are completely ignoring right now are the inflationary repercussions of some of these cesses which have been slapped and which are only coming out in the fine print. What they're rejoicing right now is that taxes have been left untouched. It's a very growth-oriented budget. What should the markets be focusing in on once this frenzy settles down?
So Aisha, this is relief rally from whatever apprehension people had in their mind about corporate tax could go up, or some kind of a COVID cess could come, HNIs could be asked to pay some more taxes. So there was a very strong feeling from very fact that a market is rallying very strongly. It shows that there was a lot of apprehension about the budgetary proposal. So that uncertainty is behind. Corporate tax of 22, 23% or 25% is confirmed, and most of the provisions will stay where they are. Their government expenditure last year in a COVID hit period, they did 34.5 lakh crores. And currently, we are not seeing the budget at a glance, aggregate numbers. But I think they said it is 34.5 lakh crores again. So government's expenditure, though the composition of expenditure is going to shift more towards capex by about 1.5 lakh crores or something like that. But within that 1.5 lakh crore, it looked that they have proposed a lot of schemes. And there are some more investment-oriented proposals with the DFI and other things. But I think the real thing is the insurance going from 49 to 74%, and the basic attitude of the government, accepting that the minimum government and maximum governance. On that aspect, they proposed a lot of things, but will they be able to actually execute? The past track record of divestments have been pretty dismal. So again, 1.75 lakh crores of credit they have taken in the budget. So can they execute? As the execution starts, I think the real growth momentum in the economy will pick up even more.
That's the other thing, you know, Nilesh, because part of the prognosis of why we were seeing dollops of FII money come in, I mean, beside the fact that the dollar was moving the way it is and emerging markets were benefiting from that, was also the low interest rate regime. Now, given what the budget has done in terms of fiscal deficit and the, you know, the farm cess on petrol and diesel that I just read about, these, of course, have huge inflationary repercussions. At some point in time, the central bank will have to get up and take notice of inflation actually picking up, and the interest rate trajectory will turn. How soon before the markets actually realize that, and some of this knee-jerk reaction that we see begins to settle down? Or you think the markets don't need to worry about that as of now, because you've got the FII hand on you and you've got earnings growth which is picking up?
Well, so clearly, inflation, essentially, there were already inflationary tendencies which were even visible before the rollout of the budget, given the kind of spike that we've seen in commodity prices globally. But of course, still now, central bankers world over still don't seem to be too concerned about it, and clearly continue to unleash liquidity. And of course, globally, still inflation is well under control. That's also getting manifested in India as well, as our inflation has not yet started to kind of raise its head as yet, and maybe there is still a time window of maybe a few months. And in that context, I think clearly there is this is less of a reason for worry. Clearly, as far as FPIs goes, they're looking at India as essentially a growth destination. For them, what is more important is the fact that IMF is projecting India to kind of grow at 11% over the next 12 months and emerge as the world's fastest growing economy. So clearly, I think that is very important, and that this budget, in a way, continues to basically, in a way, support that investment thesis that we will remain a growth-oriented economy. As far as this budget goes, it continues to kind of unleash measures which will ensure that the growth extends well beyond the next 12 months. And as long as India continues to basically report high single-digit growth at the GDP level, I believe that the interest in India will continue as far as FPIs are concerned. Yes, of course, if there are any talks of rate hikes or measures to curb inflation globally, that of course will create its own set of volatility, which probably will be there for the very short term. But I still believe that the medium to long-term trend is intact, primarily stemming from the fact that India remains a very high growth destination. And that, I think, is the most appealing fact for FPIs world over.
Right, Nilesh. Thank you very much. Bala, equity markets are on steroid. Bond yields are at a 4-month high. Now, equity market in the short term can be emotional. It could be sentimental. It could be positioning, because the run-up was very, markets sold off in the run-up to the budget. Where do you think markets will normalize? Because it's not that earnings are going to completely catapult to a different level. Market valuations are already slightly higher in certain pockets. Post the budget, Bala, now that the event risk behind us, where do you see the near-term trajectory of the market moving, Bala?
I think the way the budget has articulated the importance of getting back on growth, as I mentioned earlier, allocating higher amount of resources towards capital investment, means they are quite serious about bringing back the economic growth, which essentially means high cross capital formation will lead to a better recovery for most of the sectors. Therefore, the earnings visibility gets further strengthened. Therefore, from the equity market point of view, will remain at the buoyant, though the market has gone up by 3.5% today. Overall, buy-ins towards the equity market that should stay at least for next 3-4 months. And given the fact that the budget provisions are going to actually drive that sentiment. Second, as far as the interest rate goes, I think as you mentioned about today, the yields have gone up. There's no doubt the yields have gone up by about 7-8 basis points, by almost about 1 rupee fall that we have seen in 10-year bond, and roughly about the same amount in the 30-year bond. And given the fact that the overall interest for, if the yield rises, then actually is going to help the buyers of these bonds at higher yield, and therefore there's going to be an incremental demand is going to come to fulfill the need for borrowing this from the market. Therefore, there's not going to be much pressure in terms of the yields going up further. And second is overall the goalpost, even as they have done in the case of FRBM Act, the goalpost for most of the central bankers, not just only in India, even globally, has gone from their 2% say average inflation, which is the target. Now they are moving to actually towards the average inflation over a period of next 2 years. Therefore, most of the central bankers globally have said that till 2025, they're not looking at a scenario of rising interest rate on the fear of inflation going up. I would assume this will also be equally applicable for India. At least for a considerable period of time, you don't see the interest rates rising. Therefore, it gives actually a much elevated confidence on equity market. Therefore, it should remain buoyant.
Bala has actually given a 9 on 10 out of budget. I will not ask Ramdev Agrawal for a budget figure, but Ramdev, the fact that the market now is tilting towards infra, corporate banks, IT, pharma are taking a back seat. Are we at that turn? Are we at that turn, looking at the nature of the economy, that markets, they need to start looking more inward? Do you think now pharma, IT could underperform and the outperformance, moves completely in favor of cyclicals and industrials? Ramdev?
Cyclicals have been obscenely priced, so they have to take a rest, and market is already giving indication. And all the cyclicals or the new growth sectors, whether it is manufacturing, whether it is automotive, corporate banks. Now, what market is seeing is that all the banking side, particularly corporate bank, they get impacted by the credit cost. Now, the current budget probably gives a hint that there will be a very strong recovery in the economy, and the stress on the credit cost side will come down. And hence, the corporate profitability, corporate bank profitability will come back. So all kinds of positivity is building up, and I think the set of companies which are going to do well natively are going to be different than what it was. So almost, the portfolio has to have at least 50% the cyclicals and the new winners which are going to come up.
Rajesh Sharma of Capri Global joins us now. Mr. Sharma, looking at the way markets are doing cartwheels, I'm using the word cartwheels on purpose. In India, I could use the word balle balle, but that is the sentiment what markets are. What is exciting you about this budget?
So I think this budget is providing a very long-term policy on a direct taxes. Every year we used to speculate, and investor, including corporates, used to see what changes it could be. So I think as a country, we need at least 3 to 5 year clarity on the direct taxes. I think not changing the direct taxes is giving a very clear view. The government wanted a long-term view and stability on the direct taxes. So that is a very, very big upside. Yes, it is a message to everyone. And second, the setting up of DFI, which is a requirement for our capex, and the new industrial expansion can get the loans, because past few years banks were facing problem to lend long-term loans. They were having asset liability mismatches. So I think DFI will be able to address that. On the asset reconstruction side, to address the NPA issue, the bad bank, and kind of a setup they are talking about asset reconstruction company. So, and there's a focus on the healthcare. So I see within the constraint, this budget has tried to do everything possible, and I will rate this budget 10 out of 10. I think the government and the finance minister has done a very good job in this time.
Maithili, why are you giving a 6 on 10 out of 6 on 10 for this budget?
Yeah, I'll tell you why, Nikunj. In terms of intent, I would give it an 8 on 10. But given the track record of the government in delivering on its promises in the budget, whether it is in terms of privatization of IDBI, which they promised last year, IPO of LIC, the disinvestment target that they had of 2.1 lakh crores, against which they've achieved less than 20,000 crores. So there are a number of things that one needs to take with a very big pinch of salt. Also, the COVID vaccine, the kind of rollout that they have, the 35,000 crores, is grossly insufficient given the population that we have if we really intend to vaccinate everybody. So there are a number of ifs and buts. We've seen again the question of a DFI. Now, this is an experiment. We've tried and failed miserably in the past. We already have existing DFIs. We already have an IFCI. We already have an IIFCL. So why not recapitalize those DFIs rather than set up a new DFI? So in terms of intent, I would give it an 8 on 10, but in terms of actual deliverables and what is possible, and this is also being generous, I would give it only a 6 on 10, Nikunj. So at the moment, yes, what I appreciate really is the expansionary push that is given was necessary, the increase in capex necessary, increase in healthcare necessary, increase in FDI and insurance, all that is necessary. But on a number of other fronts, I'm not sure whether they'll be able to deliver on the promises for a variety of reasons that we've seen in the past. In fact, Yashwant Sinha spoke about reducing government holding in public sector banks to 33% way back in the 90s. Where are we now? So I really have my doubts on that. So I said, I'll repeat, on intent, 8 on 10, on actual deliverables, even being generous, only a 6 on 10.
Right. You know, on that intent and deliverable point, Ramdev, if I could come to you, because while the divestment policy has been cleared, the finance minister spoke about LIC disinvestment as well. You think delivering on disinvestment is something which becomes paramount right now? It's been a tall order for the government. Unfortunate as it may be, the pandemic only pushed the disinvestment process a little behind. But do you think the government will be able to successfully kickstart the disinvestment process this time around for sure?
At least the intent looks to be pretty strong, and environment. I mean, you have to also give credit for not doing it in the sense that last year COVID impacted capital markets. So only in the second half it picked up. So I think now from here they'll get a full, very good markets to. With the full of liquidity, global appetite, outlook is very good. Your forex balance is very good. Your food buffers are very good. So I think all micro aggregates are very good, and it is a matter of execution. You cannot. But my sense is that tax estimates have kept the cushion. I mean, actually they're not taken against 13.5 lakh crores. They've talked about only 15.5 lakh crores additional tax. I mean, total tax mobilization. Revenue is very, very small. My sense is it will be so even if there is a shortfall in the capital received by way of divestment, which one should assume some amount of deficit, I think they have enough cushion on the tax side. So I think the budgetary numbers will not go anywhere. The issue is the execution of divestment. That must happen absolutely religiously, and nobody can give any guarantee whether it will happen or not. The past track record has not been good.
Couple of sectoral specific announcements as well, and if we can just bring up some of those stocks, while of course the index along with the Nifty Bank is doing what it's doing. Oh, by the way, just 7 points and we'll make it to 14,200 now on the Nifty futures. And I'm just looking the F&O picture here. There are only 10 names which are sitting to the declines within the breath. You've got a good 132 stocks sitting to the green right now, and barring fertilizer, which also is getting dragged only because of UPL, it's a constituent of that particular index. And technology to some degree, you've got some names like a TechM which have been in the red from the word go, and perhaps Wipro, which has had a bit of a choppy ride and settled now lower. Rest of the market is rip-roaring. All sectors leading, led by, of course, banks. You've got telecom, textile, infrastructure, financials, capital goods, cement, automobile. All of them are charging up ahead as we speak right now. Remember, tax holiday for more than 1 year now for affordable housing, which is why I guess you're seeing this entire, excitement play out in cement, as well as the real estate ancillary sectors as well. Relaxation on private funding in infrastructure as well has been announced in this particular budget. The FDI on insurance, of course, has been hiked. We were chatting with Vibha as well earlier about this. Nationalized AMC and ARC models. This also along expected lines has been announced. Healthcare spending, of course, has been upped to the tune of 2.24 lakh crore rupees. And railways can now monetize dedicated freight corridors. So some of these specific sensitive stocks are the ones which are holding up very smartly. Rajesh, before we let you go, anything that you'd like to highlight from the budget this time around? Something that you'd monitor even post-budget?
So if we talk about MSMEs and affordable housing, I think with the increase in industrialization, a lot of other shops, the MSME are going to be a direct beneficiary. There's a higher allocation of the affordable housing and the NHB subsidy side. So I think overall, if we talk about this budgets, there's no negative, at least I could see, though I have not seen everything in fine detail yet. And I think every time we were afraid that something new cess will come, or maybe because of the COVID, some tax may come, which has not happened. So I think it is a plus for thing. And I think there's for everybody, there is something or other. So I think it is a positive for us.
Really appreciate your time. Jim O'Neill joins us now. Of course, Jim needs no introduction whatsoever. Viewers always look forward to his thoughts on the budget day when he interacts exclusively with ET. Now, Jim, good morning to you. Thank you for joining us. I'm sure by now you must have looked at the headline and the fine print of the union budget 2021-22. What is your sense?
I haven't looked at any fine print, I'm afraid to say. It's quite early in the morning here in the UK, but I've looked at the headlines. I mean, the most important thing I think I would say is what the consequences of the budget will be less than the world's success and India's success on obviously containing this pandemic and recovering from it. And what is appears to be quite fortuitous for India is that the budget arrives at a time where it seems as though the infection rate is slowing sharply in India and in some other important countries. And of course, crucially, we're starting to see vaccines rolled out in many parts of the world, including India. So the background environment is helpful. My other response is that it looks to me, by and large, as though there is no one particularly eye-catching thing in the budget, and by and large, it's one designed to account for what the government has had to do in the past year and needs to keep doing as a consequence. But I'm sure there are some specific things for some specific sectors that are better than not, but there doesn't seem to be anything dramatic from a macro perspective that catches my eye.
Okay, Jim, we'll give you some time to go through the finer details. But Sunil, if I could come to you, I was just going through some of the sector-specific announcements which have been made. And the farm cess on petrol, diesel aside, what is it that you're making of the thrust that the government is A, giving on healthcare and B, on affordable housing? We've often talked about the kind of recovery that is played out in the market with, some of the real estate names, the real estate ancillaries, the home improvement names already. Do investment in some of these stocks only become dearer now with the announcements in the budget?
So one is this increase in agri cess on petrol and diesel is net zero impact to final consumers because some other players have reduced it. So that is one thing. Second is, very clearly, I think one is the government has been very vocal last few years about Make in India and, housing for all and so on and so forth. However, there has never been a very forceful attempt to lay down a policy from a 3 to 5 years perspective, which has been done this time. So, while the past might be taken with a pinch of salt, I think this time it is more credible because we are laying down a 3 to 5 year roadmap. The other thing is that, all said and done, the lower interest rates, particularly on the mortgage side, has automatically made housing almost 25-30% cheaper. And that is a bigger driving force for people to buy a house rather than any tax incentive can do. So, our view would be that as long as this lower interest rate regime continues, and at least I am on the camp which believes that this is a trend which is going to last at least for 3 to 5 years, housing for one will keep on getting a good demand on the residential side. And that would mean that ancillary sectors, whether it is cement or building material or some other sectors, would continue to gain a lot of traction. One thing is we are more constructive on I would say, the Bharat part of it. So maybe tier 2 and tier 3 cities, which is more on the affordable side than the ultra luxury side, because the impact on some of on the ancillary sectors is more on that segment.
14,182 now for the Nifty. It's a 475-point move. Yes, you heard me right. 475-point uptick that you're seeing on the Nifty futures. It's a solid breath. There are only 11 names within the F&O universe which are sitting to the red right now. IndusInd Bank leading the charge with an 11.6% uptick. Next up, ICICI Bank futures up almost 11%. Chola Finance up 10.5%. SBI now sitting pretty with an 8.6% gain on the futures, and Bajaj Finserv as well, which is leading by a solid 8.5% uptick on the futures as we speak. Bala, would the DIIs finally join in on the party, or are they going to continue to be net sellers, as has been the case for the better part this year?
I would assume this year we'll see the trend changing. The confidence which has been coming back to the market in general for the equity market. Probably that should now result in money coming back to the domestic mutual funds. And we are already seeing that happening with the last 1.5 months, where there has been a reduction in the general redemption rates. And now the SIP registration rates have been going up. Probably I would assume 2021 is going to be the big comeback of mutual fund flows in the equity space. And having now seen such a sharp rise in the market, have gone back, have actually brought back the return, where the other way they would have lost during the pandemic period. So if you look at in the month of January, end of January, or maybe as you move on, look at the past returns, everything will look good. And that's what I think boosts the confidence of investors. And the lastly, of course, the budget, as everybody has voted 10 out of 10, 9 out of 10. And as others have mentioned, there's a high credible budget, I would probably say, giving a roadmap for the next 2-3 years. And also making a lot of this irritation kind of stuff, especially with income tax and tax filing of return, etc. All such things maybe will go a long way in bringing back the confidence of investors into the market.
Okay. Well, in minutes from now, Mr. Ashok Tyagi of DLF will be joining us, but I'm going to go back to Jim O'Neill. Jim, historically, global rating agencies always look at the deficit number. But the bond markets in India are not nervous. I mean, there is a bit of a spike because fiscal deficit number is nearing 7%. But do you think globally, while looking at India, where historically we've always looked at our deficit numbers as a concern and a macro risk, do you think investors will continue to overlook it?
By and large, in the circumstances we face right now, yes. I think very importantly linked to this question is the IMF in its appearance at the World Economic Forum last week, which was, I assume, using to highlight in particular its latest stance on this, from what I can see, made a very, very clear point of saying that because of circumstances that have materialized around the world, there needs to be a change as to how people think about fiscal spending. Almost essentially saying to world finance ministers, it is okay for you to run, in our judgment, large deficits because of what's happening. And in that regard, I think the markets will take the cue from that. And to some degree, although obviously the nuances will be different, but by and large, I think the rating agencies will follow the same general stance. So I think the markets have nothing to overly worry about there.
Ashok Tyagi joins us now. Mr. Tyagi, pleasure to have you on ET Now. Thank you for joining us. Mr. Tyagi, so far, the lowest rating we've got on the budget is 6 from Metli, and the highest rating we've got is 10. 9 being the consensus number. What is your number for this year's budget? Mr. Tyagi, can you hear me?
Yes, I can. Thank you.
Okay. I'm saying that the lowest rating we've got from a panelist for this year's budget is 6. Highest is 10. The consensus is 9. Which way would you lean?
I'd say 8 to 9. I mean, somewhere between 8 to 9, I think is the right rating for sure. I mean, if you had to quantify it.
Why would you give it 8? Why would you give it 8? Why not 6 and why not 10? Let's debate that.
So, I mean, clearly, if at all you have to choose between a 6 and a 10, it's clearly closer to a 10 than to a 6 for sure. You know, and I heard the panelist who had given a 6, and her concerns are also more on the possibility shortfalls in implementation versus the budget itself. You know, the country needed a spending-oriented budget. This is a massive spending-oriented budget. You know, the outlays on infra, the outlays on divestment, the outlay on health. I mean, yes, would I have liked some more specific steps around stuff like real estate? For sure. But I think in the overall context, I think this is exactly what the doctor prescribed. You know, this is an extremely spending-oriented budget. And the fiscal deficit numbers, both for this year and next year, reflect that. So I think clearly, I mean, this is a very strong budget, from what is required today.
Okay. Let's understand what has come for the HFC space and the implications of that. DLF is not in the low-cost housing space, but the incremental impact of if HFCs are doing well, real estate in general will do well. What has specifically come for your sector, which is in a sense exciting you to go towards 10?
Okay, so I think the 2 or 3 things. Directly speaking, clearly the extension of tax holiday on affordable housing is a good thing, and while obviously not in NCR, but I think some of our projects potentially launches in the other geographies could qualify for that, especially in areas like Tri-City, Chandigarh, etc. B, clearly the continuation of the lower tax regime, which is not necessarily budget driven, but the overall ecosystem, I think that has been a huge kicker to this entire demand in the real estate space that one's seen in the last few months. Then there were 2 very focused, positives for the REIT markets. One was that FPIs would be allowed to invest into REIT debt bonds, and B was that on the REIT dividend distribution, there will be no TDS, which again, sort of strengthens the entire REIT ecosystem. I think those were specific steps for this. I mean, for our sector. But Nikunj, as you would also appreciate, I mean, a huge infra spend does lead to a real estate uptake also, maybe with some degree of lag. So I think it does sort of create an overall optimistic ecosystem in the entire place.
Okay, Jim, we had invited you to discuss budget, but when I look at my screen, it is silver which is making everybody surprised. Now, Jim, what is happening in the world of finance? Hedge funds are getting booted out, and retail investors and traders are winning the race. Last week it was gaming names like GameStop, and this week it is silver. What is happening to the world, my friend? Silver prices have gone through the roof, Jim.
Well, it's like some kind of revolution. It's peculiar, but I have to say, given how my own mind has been in the period building up to the pandemic and the issues that the pandemic has exaggerated, that there's part of it that I welcome. I think it's a bit of a wake-up call for the narrow world of finance. I think I've talked to you before about we need to move into a world of what I generally call profit with purpose, where everybody involved in global business, whether it be investors or corporations leaders, think about the societal goals that we need to help achieve, and not just purely focus on narrow profits. And I see the uprising of forces that have driven the rise of GameStop and the concept. At its core is normal human beings saying, well, listen, we can use modern technology to think about things to help ourselves and highlight things that can be done differently than the way you masters of the universe have been doing them. And whilst there are very specific concerns that I have about aspects of it, I hope it will force policymakers to think a lot more broadly than how they often seem to have done, by and large, for the past 12, 13 years since the global financial crisis. So to some degree, I find myself perhaps surprisingly welcoming this sort of questioning of the status quo in which the world of finance has existed for so long.
$500 points higher. You heard me right. You know, this is no joke. 14,000 to 46 now on the Nifty. And to think of it, we were cribbing about the fact that from that top of 14,700 on the 21st of January, the markets have slid for the last 6 consecutive sessions, and the FIIs have turned net sellers in the last 6 days. 4% higher on the Nifty. I repeat, 4% higher on the Nifty. Mr. Tyagi, the affordable housing segment aside, you should be very happy with this stock market recovery, because all the stock market income typically finds its way into lavish and luxury homes, thereby benefiting companies such as yours.
No, I mean, clearly from a, I mean, not the stock markets per se, but obviously
a more vibrant and buoyant economy, a more vibrant and buoyant economic sentiment. All of it, you are right, does have some degree of correlation with the demand for not only affordable, but the premium and luxury housing as well. And I think, overall, I mean, if the people who would potentially invest in houses are feeling good and are making money, I mean, it's obviously all a positive.
The feel-good factor typically does magic. But Jim, if I could come to you, what we're seeing right now, of course, is a knee-jerk reaction to the budget, and the markets are liking that it was a no-harm budget, it was growth-oriented, expansionary in nature. But would this also not make India very expensive in the pool of emerging markets, and thereby would the FIIs then refrain from putting in more money into India?
I don't see it that way in the near term. I mean, ultimately, depending on how much the market rallies, that would be the case. But as I think I've discussed with you guys recently, we have an extraordinary generous environment for emerging markets right now. In many ways, if you tried to write down on a piece of paper what would be the ideal circumstances for emerging market equities, and we kind of have them. We have, on a global basis, an extremely accommodative fiscal policy, and that's been enhanced as a result of Biden's election to president in the States. We have an extremely accommodative monetary policy, and with both of those, we generally have a quite soft dollar. And so for any country that's regarded in market size as an emerging market that has attractive yields relative to the US or in absolute terms, on top of it then introduces its own expansionary fiscal policy, which India's done today, you end up with the consequences we have. And I think we're going to see more of this in more so-called emerging markets in weeks ahead. At some point, if we start to see a big rise in global bond yields, then that will be a time that you might call payback time. But because of the scale of accommodation of monetary policy, I don't see that in the near term.
All right, Jim, really appreciate your time. Thank you for joining us. It gives me great pleasure to bring on board Dr. Pawan Goenka of Mahindra & Mahindra Group to talk about budget. I mean, looking at the market reaction, markets are doing cartwheels and Mahindra & Mahindra stock is up 8%. Perhaps everyone is excited about the farm outlay and the fact that this is going to be an expansionary budget with real focus on growth. What would be the right word, Mr. Goenka, to describe this year's budget? Hope or growth?
Say it's a budget with the head and the heart in the right place. And this is kind of what the industry was hoping for, which will be a growth-oriented budget. And that's what the finance minister has delivered with emphasis on healthcare sector and the infrastructure. And they're the two biggest enablers that we were looking forward to.
Okay. How excited and delighted you are that there are no changes in the direct tax? I mean, this was a time when clearly the finance minister, if they would have, made a demand for higher COVID cess or some surcharge, that could have been easily absorbed and it would have been easily understood in a pandemic year. But no, she did not decide to change that.
I think it was, in my opinion, prudent thing to do, not to put any fresh tax burden on taxpayers, because right now many people are in fact affected in terms of lower income for a variety of reasons. Some people have lost their jobs also, unfortunately, and therefore at this time to increase taxes on any segment of the population would probably have been a big negative and would have really hurt the sentiment. So I would say it's actually a bold move on the part of the finance minister not to increase any taxes, at least not to increase any direct taxes. And indirect taxes, there's some little tinkering here and there, but there is no major increase in indirect taxes either. So I would consider this a very good and a very bold move by the finance minister.
One concern has been the excise duty on fuel, which is petrol and diesel. And in this budget also a cess, additional cess has come. That is something which is slightly annoying, that government is taxing what is easy for them to tax.
Well, that is of course always the case, that every government does what's easy to do. But having said that, we need to look at the fine print, because the FM did make a statement that the way the cess is going to be increased, it's not going to have an impact on the consumers. So I do not know if there's an offsetting of the cess that is being done somehow. We are still trying to read the fine print. I would be surprised if the cess of $4 or 2.5 rupees will completely get passed on to the consumer, because that will be a very big burden and would have, in fact, we were hoping that the excise duty will go down on petroleum products because of very high prices right now. So we'll have to watch the fine print there. But that's one concern, because when I look at the tickers that are coming on TV about the various agriculture cess amount, they appear to be very large. And we'll have to see what that leads to.
Mr. Goenka, there also is a rejig in import duties. Now a free market economist would say that increasing in import duties and custom duties is challenging. You are in a global competitive environment and you can only protect your industry to a certain level. As an ideology, was that a good idea in this budget? Because duty rejigs have happened.
Well, I would, as first of all, I agree, and I have said this many times, that I am not very excited about protecting the local industry by increasing a tariff on incoming, because that does not make the industry competitive. And if we really want to become export worthy, we have to become competitive, and that won't happen if we increase the import duty. So as a general principle, I agree with that. However, if you look at what has been done, I think it's very focused and only on a few items. And there must be a good reason why these items have been touched. In fact, for steel, duty has been reduced from 15% to 7.5%, it seems. So it's a bit of balancing that has been done. And I don't think that one should see it as a large scale increase in import duty. One should see it as a very specific intervention for variety of reasons, and obviously we won't know all the reasons why these particular goods were picked for duty increase. Like auto parts, in case of 15% to 15%, that appears to be a fairly severe increase. Again, we'll have to see the fine print as to, because currently the duty is 7.5%, 10% on most parts, and if it is going to 15% for all the parts, that would have a significant impact on the pricing of automotive products. So we'll have to again see the fine print as to where the 15% applies. But I don't think that it's a large scale increase in import duty.
Do you think the disinvestment target and other assumptions of tax growth, are they conservative, realistic, or aggressive?
I think the math seems to be working reasonably well. In the first cut, our experts have done quick math, and that seems to be working reasonably well. To talk about 6.8% fiscal deficit, I think is, I would say, a conservative number, because depending on what growth we get, and this growth-oriented budget probably will give us a little bit more growth than what we may have planned for. So 6.8%, I would say, is slightly conservative. Certainly not. Sorry, slightly. It's realistic to slightly conservative. I don't expect it to be higher than 6.8. And when it comes to disinvestment target of 1.75 lakh crore. Given the kind of strategic direction that the FM has talked about, of completing all the disinvestments that have been started in the next, this financial year, I think she said, plus talking about two banks, PSU banks and General Insurance Company, I think 1.75 lakh crore appears to be low. Maybe she's counting for the fact that in spite of the best intent, they may not be able to achieve all the disinvestment during this year, and therefore taking conservative number of 1.75 lakh crore. So I would say that overall, if I look at the math, and unless we have some kind of external calamity that affects us, we should be able to achieve this budget or maybe even do slightly better.
Closing comments, Mr. Goenka, and this is not about the budget assumption. I'm just trying to bring a very simple fact out that a pro-growth budget in an economy like India always will bring inflation back. Bond yields we know have already gone up. They are unlikely to come down now with this kind of a fiscal deficit number. So what we are taking for granted, this budget may actually hit us there, which is interest rates.
Well, I think, again, one has to prioritize. I mean, there are multiple sort of requirements that one would have in any budget or any economy. One of growth, inflation, interest rate, employment, investment, all of these. And one has to prioritize in a given period of time. And I think nobody will doubt that today, nobody will question today, the number one priority has to be growth. And that's what the budget is focused on. And clearly, to get growth, there will be certain areas where one may not get the kind of results that one would be looking for. But then again, there's next year when we come back. So if we get the 11-12% GDP growth this year, then I think we'll be in pretty good shape in FY23 to correct for what had to be compromised with to get the growth of 11-12%. And I think all of us, even in a personal finances, in a company budget, we all have to make these choices always. And same thing applies for a country's budget.
Okay, I'm just tempted to ask you one more question. I'll take the liberty of extending my appointment by another exactly a minute. The idea of getting development finance back. Now, this is an idea which in the past has not worked. I'm not getting into the name of the institutions, but institutions who were in development finance or who were financing the infrastructure space, in a sense, had a rough time. Is it an old idea coming back in a new avatar or a failed idea coming back again?
So I'm not an expert in this area, so I don't have much of an insight. But what I would like to say is that there were reasons why it didn't work the last time. And I'm sure that those learnings that comes from last time's not such a good experience will be incorporated in the new attempt. And we always have to try things again. I mean, something that doesn't work once doesn't mean that it will never work again. And we have to try old ideas with new inputs, with new initiatives, with new direction again. Otherwise, one failure should not mean that some idea is completely dumped forever. And therefore, I think that it's clearly a good thing, assuming that the learning from last time is going to help us to make it successful. Clearly, the ARC is a very big expectation that the industry had of the so-called bad bank. That would help tremendously in terms of getting our banking system in line.
All right, Mr. Goenka, I really appreciate your time. I'm going to call this budget as the budget which was the first budget of this decade, a budget in which the primary objective was to focus on health, which is what the finance minister started with. Then is hope. Hope that the worst is behind us and India has truly emerged as a superpower. And a superpower is a country which survives a difficult time, and India has survived the pandemic. There is hope that if growth comes back, the third element of this budget, things will indeed look up for the economy. And that's where I think the government is prioritizing rather than ignoring the compulsion of fiscal deficit. They are going to be going all out on spending. And the fourth part is digital. I mean, she used to just give an example of simple things, how basic acts would be changed, how digitization is moving up. There's a renewed focus on UPI and other things. Those are the factors which also are important in terms of digitalization of the economy.